The world of investing is like a constantly shifting puzzle. Understanding the current market trends is key. Today, we're focusing on a crucial question for investors. Where can you find value in today's market? Are commodities the hidden gem? We'll compare commodities to stocks and housing. This will help you make informed investment decisions. Think of this analysis as a roadmap. We'll navigate the complex terrain of these three major asset classes. By the end of this exploration, you'll have a clearer understanding of the investment landscape. You'll be equipped to make strategic decisions. Let's dive in. To understand where we are, we need to know where we've been. History provides valuable lessons. We'll delve into the historical context of commodities, stocks, and housing. By understanding these historical events, we can gain insights into the cyclical nature of markets. By studying the past, we can better prepare for the future. Let's embark on this journey through time to understand the forces that have shaped the markets we see today. Commodities have always been the backbone of civilization. From the earliest days of human history, people have traded and bartered for essential goods. The prices of these commodities have never been static. Supply and demand have always been major factors. Political upheavals, wars, and natural disasters have also left their mark on commodity markets. Understanding the historical context of commodities requires a trip back in time. The history of commodities is a tale of booms and busts. Periods of soaring prices driven by surging demand or constrained supply have often been followed by dramatic crashes. Take the oil shocks of the 1970s as a prime example. Geopolitical tensions in the Middle East led to oil embargoes. Similarly, the gold market has witnessed its share of booms and busts. During times of economic uncertainty or high inflation, investors have flocked to gold as a safe haven. These historical examples highlight a crucial point. Commodity prices are rarely stable. Understanding these factors is essential for navigating the commodity markets. From ancient trade routes to modern markets, the way we trade commodities has evolved dramatically. In ancient times, trade routes like the Silk Road connected East and West. The rise of modern capitalism and globalization led to the development of sophisticated financial markets. Commodity exchanges emerged as central hubs for trading standardized contracts. Today, the commodity markets are more interconnected than ever before. Advances in technology and communication have made it easier and faster to trade commodities. Understanding this historical context is crucial for investors. Navigating the choppy waters of commodities in recent years has been quite a challenge. The commodity markets have been on a roller coaster ride. Global events have played a major role. The COVID-19 pandemic, trade wars, and geopolitical tensions have all left their mark. One key trend has been the divergence in performance between different commodity sectors. Understanding these recent trends is crucial for investors. You need to dig deeper, analyze the factors driving each sector, and identify potential opportunities and risks. The COVID-19 pandemic sent shockwaves through the global economy, and commodity markets were not spared. Lockdowns and travel restrictions disrupted supply chains. The energy sector was hit particularly hard. Oil prices crashed as demand for transportation fuels evaporated. On the other hand, demand for some commodities surged. The pandemic highlighted the vulnerability of global supply chains. It also underscored the importance of diversification for commodity investors. The fight against climate change is reshaping the global economy. The transition to a low-carbon future is creating both challenges and opportunities for commodity markets. Demand for certain metals is soaring. As the world embraces clean energy, the demand for these green metals is expected to continue to rise. On the other hand, the shift away from fossil fuels could weigh on demand for oil and natural gas. The green revolution is still in its early stages. Investors who can identify the winners and losers in this transition stand to benefit. The price of any commodity boils down to a fundamental economic principle: supply and demand. When supply outstrips demand, prices tend to fall. When demand exceeds supply, prices rise. Think of it like a seesaw. The commodity markets are constantly trying to find a balance between these two opposing forces. Understanding these dynamics is crucial for investors. Let's start by examining the supply side of the equation. Several factors can impact the production of commodities. For agricultural commodities, weather is a major wildcard. For energy commodities like oil and natural gas, geopolitical events and production decisions by major oil-producing nations can create significant price volatility. Technological advancements can also impact commodity supply. Understanding these supply-side factors is crucial for investors. Now, let's turn our attention to the demand side of the commodity equation. One of the most significant drivers of demand is economic growth. When economies are expanding, businesses and consumers tend to consume more commodities. Population growth also plays a role. Consumer preferences can also impact demand. Understanding these demand-side factors is crucial for investors. Identifying long-term trends in the commodity markets is essential. Inflation is a silent thief. It erodes the value of your hard-earned money over time. For investors, inflation is a serious concern. If your investments aren't growing at a rate that outpaces inflation, you're actually losing purchasing power. That's why it's crucial to consider inflation when making investment decisions. You need to look for assets that have the potential to outpace inflation. Commodities have historically served as a potential hedge against inflation. Commodities are essential goods. When inflation rears its ugly head, the prices of these essential goods tend to rise as well. For investors, this means that owning commodities during periods of inflation can provide a level of protection. As the prices of goods and services rise, the value of the commodities used to produce them tends to rise as well. This can potentially offset the erosion of purchasing power in other parts of their portfolio. So you're intrigued by commodities. You understand their historical significance. You see their potential as an inflation hedge. There are several avenues you can explore. One option is to invest directly in physical commodities. For those seeking a more hands-off approach, exchange-traded funds, or ETFs, offer a convenient way to gain exposure to a basket of commodities or specific commodity sectors. These ETFs trade on stock exchanges, making them easy to buy and sell. Remember, diversification is key to any sound investment strategy. Commodities can play a valuable role in a well-diversified portfolio. By including commodities alongside stocks, bonds, and other assets, you can potentially reduce your overall portfolio risk. This non-correlation can help smooth out the bumps in your portfolio's performance. However, it's crucial to remember that commodity investing is not without its risks. It's essential to do your research, understand the dynamics of the commodity markets, and consider your own risk tolerance before diving in. The stock market is a captivating arena. It's where companies go public. Investors buy and sell shares of ownership. It's a place of immense wealth creation, but it's also a place of risk. Understanding the historical context is crucial. The stock market has witnessed incredible booms and devastating busts. Section 2. Riding the Tech Wave: The Rise of Silicon Valley and Beyond. In recent decades, the stock market has been profoundly shaped by the rise of technology. Silicon Valley emerged as a global hub of innovation. Companies like Apple, Microsoft, and Amazon revolutionized the way we live, work, and communicate. The growth of these tech giants has been nothing short of remarkable. They've generated enormous profits. They've created millions of jobs. They've also attracted trillions of dollars in investment capital. The tech sector's dominance has been a major driver of the stock market's overall growth in recent years. However, it's also raised concerns about valuations. Some analysts argue that tech stocks have become overvalued. They point to high price-to-earnings ratios. Others argue that the tech sector's growth is far from over. They believe that these companies are well-positioned to benefit from continued technological advancements. The debate over tech valuations is likely to continue. It's a reminder that the stock market is always evolving. Navigating stock market cycles. The stock market is like a roller coaster with its ups and downs. Economic data, corporate earnings, and geopolitical events drive these fluctuations. Investor sentiment plays a powerful role. Optimism pushes prices higher. Pessimism leads to market declines. Bull markets are followed by bear markets. Focus on long-term investments. Beyond the hype using valuation metrics to assess stocks, investing in the stock market can feel like navigating a crowded casino. Everyone's got an opinion. Tips are flying around. But successful investing requires a cool head and a data-driven approach. Valuation metrics help you assess whether a stock is overpriced, fairly priced, or a potential bargain. Think of it like kicking the tires before you buy a car. The price-to-earnings, PE ratio, tells you how much investors are willing to pay for each dollar of a company's earnings. A high PE ratio could indicate that the stock is overvalued. The stock market is driven by two main forces: fundamentals and sentiment. Fundamentals refer to a company's financial health, its earnings, its assets, its management team. Sentiment, on the other hand, is all about how investors feel. Are they optimistic about the future, or are they fearful? Investor sentiment can be a powerful driver of stock prices. When sentiment is bullish, investors are eager to buy stocks, often pushing prices higher, even beyond what the fundamentals might justify. This can create asset bubbles. Conversely, when sentiment turns bearish, investors head for the exits, selling stocks and driving prices lower. This can lead to market crashes. Gauging investor sentiment is both an art and a science. There are various indicators that analysts use to track sentiment, such as market volatility, put-call ratios, and investor surveys. By understanding the psychology of the market and monitoring sentiment indicators, investors can gain valuable insights into potential market turning points. The housing market is a cornerstone of the economy. It's where families put down roots, but it's also a source of great opportunity and risk. The market has seen dramatic swings. Remember the mid-2000s housing bubble? Easy credit and low interest rates fueled a surge. The bubble burst in 2008. Home prices plummeted. Millions went underwater on their mortgages. Eventually, the market rebounded. Home prices climbed, reaching new highs. Today's housing market presents a mixed bag for investors. Home prices in many areas have continued to rise. Low mortgage rates make borrowing cheaper. Affordability has become a major concern. Rising home prices and stagnant wages make it difficult for first-time buyers. The COVID-19 pandemic brought significant changes. Demand surged for larger homes in suburban and rural areas. The housing market faces several challenges ahead. We've journeyed through commodities, stocks, and housing, unearthed their historical performance. Let's compare these investment options. Commodities offer a hedge against inflation. Stocks offer high returns but come with risks. Housing provides shelter and investment returns. Rising interest rates could cool the housing market. So, which asset class is right for you? There's no one-size-fits-all answer. Your ideal investment strategy depends on your individual circumstances, your risk tolerance, your financial goals, and your time horizon. If you're seeking a potential hedge against inflation and are comfortable with volatility, commodities might be worth considering. If you're looking for long-term growth and are willing to ride out market fluctuations, stocks could be a good option. If you're seeking a tangible asset with the potential for rental income and appreciation, real estate might be appealing. Remember, diversification is key to any sound investment strategy. Don't put all your eggs in one basket. Instead, spread your bets across different asset classes. Consider your own risk tolerance. It's also crucial to do your research. Understand the dynamics of each market. Consult with a financial advisor if needed. Investing can be a rewarding endeavor. make informed decisions, navigate the markets with confidence.